Good morning, everyone. Very warm welcome. Hope everyone is staying safe and healthy in these current times. And thank you for joining the Lloyds Banking Group Commercial Banking COVID Government Funding Scheme webcast. For those of you that I have not interacted with, my name is Scott Barton, and I have the privilege of running the corporate and institutional coverage business as part of the commercial banking business. Just as a point of orientation, this webcast is very much designed for our large corporate clients. So we're going to cover the COVID government schemes, which are the CLBILS schemes, so that's CBILS large, the Export Development Guarantee scheme, and also CCFF, which is at the commercial paper end of the market. So if you are a smaller business and you're more interested in CBILS, then this is not the call for you. But I do want to stress that clearly we are very much embedded on the CBILS scheme as an institution. So we have lots of literature, podcasts, webcast recordings that are available. So please come to me directly or your relationship manager if it's more CBILS that you're looking for information on. Now, our objective today is to ensure that you have as much information to hand as possible on the various COVID government schemes. I think we would be the first to admit that through our work with HMT and also the Bank of England, that it takes some time to digest the detail. And on a number of occasions and on a number of the schemes, it's been pretty fluid in terms of composition, but also eligibility criteria as well. What we want to do is assure you that Lloyds Banking Group will be by your side to navigate these schemes where required. And of course, we'll make sure that we're deploying our balance sheet and resources to support your business. And if, having listened to the various schemes and the eligibility, you feel that none of those are applicable to you, then absolutely we stand ready to work with you to tailor something specifically for your needs. In terms of the running order for the call, I'm going to shortly hand over to James. James runs our complex lending business in Commercial Bank, and he will talk about the CLBILS scheme, so CBILS large. We will then move on to Olivier. Olivier is a senior advisor in our global transaction banking business, and he will talk us through the Export Development Guarantee. And then last but certainly not least, we've got Glenn Forbes. He's a managing director in our debt capital markets business, and Glenn will talk us through the CCFF scheme. So without further ado, I'm going to now hand over to James.
Thank you, Scott. So obviously, I think people will know that the CBILS and CCFF went live at the end of March. As Scott says, we're not going to focus particularly on CBILS today because this is for larger business. The CCFF, we will have some detail about in here. Following the launch of those two schemes, the government turned its attention to what has been termed by the CBI the stranded middle, the companies for whom the CCFF and the CBILS scheme are not applicable. Lloyds, I'm pleased to say, was one of 7 banks involved in the design of schemes between the launch of CBILS and the launch of CLBILS. I think what's interesting is that in the conversations that we've had with government about this, the government really has 3 clear aims. Number one, they want to provide liquidity support to businesses impacted by COVID. That is absolutely clear, and Lloyds is proud to ally on that with them. The other 2 things they need to do, though, are to protect taxpayer money. So the scheme that I have been looking at, CLBILS, is not free money. It's not particularly easy money in terms of some of its restrictions, and we'll walk through that in some detail. And the third aim is really to ensure the orderly functioning of financial markets as they always would. So they're not looking to undermine what banks normally do. The provision of a guarantee scheme effectively means that you are using banks' normal credit processes, using banks' normal coverage for people to get funds out into the economy. And they have to achieve those 3 aims within the EU state aid framework. So there are some very clear rules and some fairly detailed rules that they need to comply with on CBILS and CLBILS, because those are state aid schemes. The CCFF and the Export Development Guarantee scheme, interestingly, are not classed as state aids. They don't have to abide by some of those same detailed rules. But if we go on to the next slide, we can start taking you through the detail of CLBILS, which, as I mentioned, launched on Monday. So the scheme launched on Monday, and it is available until the 20th of October. The purpose of the scheme is to provide a government bank guarantee to banks, so that banks may support viable customers who have been impacted by the coronavirus. The word viable in there is important. That's the balance between protecting taxpayer money, that viability test that banks will do, and providing support into the scheme. So it's not necessarily that this scheme is going to go out to absolutely everyone. Banks are being asked to obey the normal credit processes that they go through. The scheme is available to companies with a turnover of more than £45 million. The initial design of the scheme, as I think people know, had an initial turnover cap on it. That cap was removed. The reason for £45 million is related to the EU's definition of an SME, interestingly. So it's a rough approximation of what €50 million is worth. The scheme is subject to a cap at the portfolio level for lenders offering the scheme of 20% of refinancing. The intention is clearly to provide incremental liquidity support to customers. What the government has a sensitivity to is existing credit decisions that banks have made being flipped into the scheme and thereby benefiting from a government guarantee. That's not the intention. That would effectively be providing support to banks. That's not the point of the scheme. The point is to provide support to customers. So Lloyds is subject to a maximum 20% of deals that we can write for a refinancing purpose. I should say, and it is early days, but the majority of conversations, the substantial majority of conversations that we've had with customers so far are about incremental liquidity, not refinancing. I do want to mention the refinancing cap though, because clearly if we started to near that cap, that may be a reason for a conversation that you have with us going in a different direction than the CLBILS scheme. The viability test, clearly there is a requirement on the bank to assess pre and post-COVID viability, so that the scheme will enable you to trade through the near-term disruption from the COVID impact. Beyond that, there is an EU rule that you may not provide support to a business in difficulty. You may not provide state aid to a business in difficulty. Those in difficulty tests I'll get into in detail on the next slide. The maximum amount available under the scheme is really capped by three things. Firstly, there is a turnover test. So if you are a business with a group turnover of below £250 million, the maximum amount available to you is £25 million. If your turnover is above £250 million, the maximum amount available to you is £50 million. Again, there are some detailed state aid rules around the amount that can be supplied within those caps, though. So we'll move on to the detail on that on the next slide. The maximum tenor of the CLBILS scheme is 3 years. We will apply amortization if we need to in a normal commercial way to that, or if you desire to have amortization, you can have it in a normal commercial way. Interesting to note, the CLBILS scheme has a maximum tenor of 3 years. CBILS maximum tenor is 6 years, and CCFF maximum tenor, being commercial paper, is 1 year. So therefore you can see the scheme clearly playing between those two schemes. Lloyds is offering a term loan product and a revolving credit facility product. Interesting to note that not all banks, the 7 accredited lenders on day one, are offering a revolving credit facility product. The scheme will potentially be expanded to invoice and asset finance. The government is still working through the detail of how a CLBILS invoice and asset finance offering would work. When that is received, we will review that, and potentially our GTB colleagues will be offering that from their side of the shop. Pricing, always of interest in a customer negotiation. So we are pricing this using a usual commercial pricing way, but we pass on the effect of the guarantee that the government gives us. So the 80% government guarantee effectively takes out 80% of the asset that we hold against the loan. So effectively makes it cheaper for us to write the loan. It provides a measure of credit insurance, if you will. But the government charges for the guarantee. So in the first year of the guarantee, banks are charged 50 basis points by the government. In the second and third years of the loan's life, we are charged 100 basis points by the government. So the net effect, without going into the great detail that we've gone to get the pricing metrics on this, can be thought of as it's a good deal to pay 50 basis points to insure, let's say, sub-investment grade companies. And therefore there is a great benefit there. It is not such a good deal to pay 50 basis points to insure the credit risk, or 80% of the credit risk, on strong investment grade businesses. So the effect of that government guarantee and the flat charge, which does not modulate upon credit, means that we can pass more pricing benefits on at lower investment grade ratings and sub-investment grade ratings. So that locks in quite nicely with the CCFF, which is available to investment grade or investment grade equivalent, even if you're not externally rated customers. This scheme plays at the lower end of investment grade and sub-investment grade primarily. That's where we can pass on most pricing benefit to you. We are not charging an arrangement fee on this product, though, unlike a normal commercial loan, given that the primary purpose of this scheme is to provide incremental liquidity support and enable you to handle what is hopefully a short to medium term cash flow difficulty. Asking you for an upfront cash cost to enter into that felt wrong to us. That's not a scheme condition. That is something that Lloyds has chosen to do, to offer this on an arrangement fee-free basis. The next rule I wanted to look at is a scheme rule, and this is, again, that desire of the government to protect taxpayers' money, completely understandably, completely rightly, is the security ranking and the seniority of the scheme. So it is quite a detailed calculation, but effectively what the scheme asks banks to do is to look at all of the security that you have granted to any bank, to any lender across any financial indebtedness, except asset finance and invoice finance. Call that effectively the relevant collateral pool, is the way it's defined. Banks may then ignore 10% of that, but we must write the loan equivalent to 90%, so pari passu, with the rest of the claims that you have over 90% of that relevant collateral. So if you already have a largely secured structure, that is, it's not straightforward by any means. Taking security, granting security, working another creditor in alongside your existing creditors never is. But it's relatively easy to see that would happen. And in most cases, banks will obviously be at one of the more senior levels in your capital structure, and therefore already we're working the CLBILS in alongside that. We are expecting some more detail from the BBB about how we are to interpret this test, in as much as if there is a very small pool of relevant collateral out there, let's say you have a small mortgage, but your capital structure is largely unsecured, it seems odd that we ought to be looking to that very small amount of security that you've granted, and that we can't work the scheme in alongside your normal unsecured obligations. Therefore, we are expecting further detail from the British Business Bank on how we are going to interpret that test in the near future. And of course, as soon as something comes out, we will update you on that. The other terms that I wanted to look at very briefly are the dividend restriction, which we have all the detail on the next page. There is a restriction on the transfer by the bank. So we are not allowed to sell out of the product, given the government is taking 80% of the risk on the product. They're clearly interested that the writing bank holds the remaining 20%. So I'm afraid if you take one of these from Lloyds, you are stuck with us, at least for the tenure of this loan. And we have worked in, as a means of making the process more efficient, into our standard loan documentation, some of the eligibility criteria, which are quite long, into the document itself, really as a way of making that process more efficient and giving ourselves the comfort on both sides that we know exactly what we're signing up to. In terms of that process, I should say, we have developed a standard suite of loan documentation which incorporates all of the detail. We have established a panel, a very small panel, effectively around 6 firms, who we have pre-agreed rates for external legal advice, so that we can minimise the costs to you of coming into these loans if that standard documentation is used. You can write CLBILS loans on market standards, so the LMA suite of documentation, etc., or using an existing revolving credit facility or term loan as a base. But because of the way the scheme works, there are some detailed rules, we've got a few on the next page, that you need to work into that document. And so really it's a question of whether we think the more efficient way of getting to a CLBILS loan is using a pre-baked template loan agreement effectively, or trying to reverse engineer an existing facility and add all those things in. Both routes are possible, I should say. It's just a question really of which we together will think will be the more efficient way of getting it done. So to come back to some of those detailed rules, the next slide has the exact, almost the exact language, and it's a typo this morning, on exactly how those work. So the 2 criteria on the left are the state aid criteria that I mentioned the scheme has to work within. So the first of these is around credit, and it is an undertaking difficulty test. The state aid rule from the EU, and this predates any of the COVID specific support schemes. This is an underlying EU legislation rule, is that state aid may not be provided to businesses in difficulty, and you can clearly see the political purpose of that when the EU is trying to operate an open market economy and single market effectively. So the test itself, though, runs that you may not have accumulated losses more than half your share capital. That's the first two limbs. That you are not subject to collective insolvency proceedings. That you have not received rescue aid, that you've not yet paid off effectively, so you can't be in receipt of two forms of state aid at the same time. And that you have not had both the following solvency ratios for the past 2 years, which are book debt to equity greater than 7.5 times and EBITDA interest coverage below 1 times. So in the corporate world generally, that will not be too much of a problem. We should say that for private equity owned companies, last Friday it was clearly made a policy objective that private equity owned companies should be able to access the scheme. The test around accumulated losses more than half the share capital, we need to work through the exact implications with government there, because that is something that ostensibly could prevent private equity companies accessing the scheme. We are still working through the detail there with government. The next rule I wanted to come on to relates to the amount that is available. The scheme clearly has the rules itself that your turnover relates to the maximum amount that you can take. £50 million above £250 million of turnover, and £25 million below £250 million of turnover. There are effectively 3 tests that the EU state aid rule applies beyond that, and it is the highest of all of these effectively. So the tests are the amount provided may not be more than 25% of your 2019 UK turnover. The amount provided may not be more than double your 2019 UK wage bill. Or, if your supplier's appropriate justification, it may serve your liquidity need for the next 12 months if that is higher than either of those 2 prior tests. So effectively, you go to the highest of those 3 things, 25% of turnover, double the 2019 UK wage bill, and your liquidity needs for the next 12 months. But you may not in any case exceed the overall scheme count of £25 million below £250 million of turnover, and £50 million above £250 million worth of turnover. That turnover is calculated on a group basis, I should say. The next 2 criteria on the right-hand side are scheme rules that I wanted to get into. And you'll have noticed on the prior slide highlighted a dividend restriction. In my experience, inserting a dividend restriction obviously is often something with an emotive aspect with companies. This dividend restriction has some interesting drafting enforced upon us. This is a scheme criteria. We must put this into every loan. If necessary, under our usual credit processes, there can be a more restrictive dividend restriction introduced. The minimum dividend restriction here is effectively a dividend increase restriction. The drafting works in a typically legal manner, in as much as the first 4 limbs say you may not pay a dividend, really any kind of dividend, no, honestly, any kind of dividend or distribution, effectively. Then the final 2 limbs say that, yes, actually, you can pay a dividend as long as you've declared that dividend or distribution before you enter into the scheme, or as long as that dividend or distribution is not more than you paid in the prior 12 months, subject to paying that dividend or distribution not having a material negative impact upon your ability to service this facility. So really, it's more of a dividend increase restriction than it is a pure dividend restriction. And the final rule that I wanted to touch on is that the 2 schemes that we're talking about first, the CCFF and the CLBILS scheme, are mutually exclusive. The government doesn't want doubling up of support effectively provided to the companies. So if you access the CCFF, if you access CLBILS, you may not have taken out money from the CCFF as well. It's an either-or situation with CLBILS or CCFF. I appreciate that is a great deal of detail. We should also say, of course, that all our RMs and all our coverage people are briefed on these schemes, so they will be able to help you through any of the details themselves. And with that, since the last one I was talking about was it's an either-or situation between the CLBILS scheme and the CCFF, worth looking at the CCFF. So over to Glenn Forbes.
Thank you very much, James. So on the slide, we've set out a sort of comparison of the three schemes. Now, the main purpose of this call is to focus on the CLBILS and the export guarantee schemes, which are much less well understood than the CCFF. But what I would like to do now is really just talk through a potted summary of the Bank of England commercial paper scheme, with a particular focus on how each of the schemes fits together into an overall package. Now, it's very clear that the CCFF scheme is aimed principally at the largest and highest rated businesses within the UK. Current outstandings under the scheme are around about just under 11 billion, with issuance running at around about 3 billion per week. And whilst the Bank of England doesn't disclose individual sort of company usage of the scheme, disclosure at the sort of company level indicates that the vast majority of that sort of just under 11 billion of outstanding issuance is from FTSE 100 companies. There has been a substantial evolution in the sort of the eligibility and the coverage of the CCFF over the last month since it was introduced, and in fact, the overall eligibility criteria continue to evolve even into this week, particularly in the area of ratings, which has proved a little bit sort of troublesome to get right first time for the Bank of England. So I think this is an area where they really are going into new territory. I think it's fair to say that the very first cut of the scheme was quite restrictive in the number of UK businesses that could make immediate use of the scheme. In fact, there have been some suggestions that there were only really a couple of dozen companies in the whole of the UK that could have made use of the CCFF scheme immediately without additional work on the ratings or documentation side. The Bank of England has done a considerable amount of work to modify its criteria in order to increase the coverage of the scheme, which again is interesting in that it shows these schemes are produced once they're seen as being sort of viable, but the government does accept that there are lessons to be learned and is open to sort of feedback on improving the effectiveness of the schemes. I had said that the first version was arguably only open to a couple of dozen corporates. We're now at a situation where there are sort of several hundred UK businesses who've already applied to the scheme, the vast majority of those getting a positive decision from the Bank of England. Now, the main change in eligibility has really come on the rating side. To begin with, the Bank of England sought short-term ratings from one of the three main rating agencies, S&P, Moody's and Fitch, and they've gradually extended what they will accept as proof of investment-grade status. What the Bank of England has not moved on is the requirement to prove investment-grade status, and also a requirement that is a broadly consensual opinion across whichever rating agencies or banks are sort of providing it. The first step in that evolution was to accept short-term ratings. They then broadened the coverage to accept other rating agencies, such as Dun & Bradstreet. But the real game changer was the acceptance of bank credit ratings in order to provide evidence of investment-grade status. The big difference between credit ratings from commercial banks and credit ratings from the statistical rating agencies is firstly in terms of how comprehensive bank credit ratings are. Frankly, the difference is really an order of magnitude in terms of how many UK corporates, have investment grade ratings from their commercial banks and how many have them from external sort of rating agencies. The second difference is one of bias in the sense that the commercial or the independent rating agencies do tend to have a very strong bias towards large companies with very strong market positions, whereas bank credit ratings tend to work much more evenly across different sort of scales of sort of companies, and that is what's made the real difference in terms of eligibility. I have mentioned that the Bank of England looks primarily for credit ratings to be consensual. In the first sort of cut of the programme, that was pretty straightforward in that if you had sort of ratings from the likes of S&P and Moody's, both had to be at investment grade, and the Bank of England would look to the lower rating in order to sort of make its decision. The thing that is still evolving within in the way that the bank looks at its credit ratings is how they deal with this issue across sort of bank credit ratings. Companies are typically coming to the Bank of England with anything between sort of 2 and 7 or 8 sort of different credit ratings. The Bank of England is using a commercial product called Credit Benchmark in order to check the information that it's receiving from individual companies. And what they have found is that many companies, particularly those with a high number of ratings, have credit ratings which straddle the investment grade space. And I think there's been a lot of sort of thinking within the Bank of England as to sort of how to deal with this. They have come up with a sort of new set of criteria in the last sort of few days, which looks in more detail at the sort of the level of credit ratings that are being provided by banks. If we go back a couple of weeks, the Bank of England was happy to simply get a reassurance from commercial banks that credit ratings were investment grade status with little additional detail. Now, in order to deal with the sort of question of sort of split ratings, the Bank of England is seeking specific rating levels that are equivalent to the sort of the rating agency sort of hierarchy on sort of credit ratings in order to deal with the problem of outliers. And the problem of outliers simply comes that if a company has 7 or 8 ratings from each of its commercial banks, on average there will always be sort of 1 or 2 who are quite simply getting it wrong or taking a rather sort of contrary view. The Bank of England realises that strong companies shouldn't be barred from accessing the scheme just because one bank, who may in fact have a very sort of weak or undeveloped relationship with the corporate, has assigned a sort of weak credit rating. So within that, what the Bank of England is looking at doing is that they will accept a rating below investment grade so long as the consensus is at least mid-BBB, and that's where they need an additional level of detail regarding the sort of ratings that are being assigned by banks. In terms of overall sort of pricing and limits, you will probably have seen already that these are simply being mapped to the overall level of rating. They're divided up by sort of short-term sort of rating level, so A1, P1, A2, P2 down to A3, P3, and the level of sort of limit is somewhere between sort of 300 million and 1 billion. Worth saying at this point that usage of the scheme as it's set out in the first instance does not come with any strings attached in terms of additional financial covenants or restrictions on sort of payments sort of leaving the company. However, we have worked with a couple of corporates who've appealed to the Bank of England to seek sort of higher limits, i.e. a limit over and above the standard sort of matrix that the Bank of England has provided. The natural reason why some companies may request this is that they may have a commercial paper already outstanding in excess of the sort of predetermined limits that the Bank of England is providing. In those instances, the Bank of England has turned very quickly, actually, to requesting sort of lockups or restrictions on sort of dividend payments. So the scheme does move a little bit sort of closer to the sort of CLBILS methodology if anyone requests a higher limit than is provided automatically. Just very quickly, in terms of the overall sort of work streams, there are 3 main work streams in gaining access to the commercial paper sort of programme. They are ratings, establishing eligibility, documentation. For many corporates, ratings will already be in place. And those that do not have them in place, it should hopefully simply be a matter of a quick conversation with commercial banks. Eligibility is something that happens bilaterally between individual businesses and the Bank of England, and recent conversations indicate that the Bank of England is taking around about 2 weeks to fully sort of grant eligibility. And then the third work stream, and the one which requires the most time, is documentation for those companies who do not already have a CP programme, and that is in fact the vast majority of potential users of the scheme. The documentation needs to be put in place from scratch. The good news is this is a very sort of standard documentation suite, and most of the sort of main legal firms in London have produced template documentation and are actually charging a sort of a level of fee which is really only consistent with covering their costs. They are trying to do the right thing here. Typically, a commercial paper scheme would normally take around about 6 weeks to put in place from scratch. But actually, with a simplified scheme and using template documentation, we've seen instances where the whole process can take as little as 2 weeks. That does require a bit of sort of dual tracking and iteration, i.e. the first call probably goes to banks to establish sort of credit ratings. The second call is into the Bank of England to establish eligibility, but eligibility cannot be fully granted by the Bank of England until the documentation is in place. So I think once businesses have got to the stage where they have a sort of warm signal from the Bank of England, then the majority are then sort of pressing the button on establishing the documentation. And within that, the main sort of gating item really appears to be internal governance. So it can be as little as 2 weeks, but historically has been as much as 6 weeks, partly determined by the need for a monthly board meeting in order to sign off documentation. Just touching briefly on overall costs, for those companies that need to set up a new programme, costs will be around about £30,000 to £35,000. For those who need to approach an external rating agency to get a new rating, each of the agencies is providing a sort of a light touch product for which they're charging around about sort of £20,000. So there's a potential add-on there. Banks would not ordinarily charge anything for the provision of an indicative rating that they have already assigned. And actually the overall sort of arranger cost, certainly in the case of Lloyds Bank, we are not sort of charging anything where we are assisting companies in putting sort of documentation in place. With that, I will hand over to the next speaker on export guarantees.
Good morning, everyone. I'm Olivier Calif. I look after export finance in global transaction banking. So I will talk you through the Export Development Guarantee by UK Export Finance, UKEF. We think it's a great addition to COVID-19 funding scheme. First, because of its features, it's a relatively new product, but it was offered before the COVID-19 outbreak to support UK export, overseas sales, which is the primary mission of UKEF as a government department within the international trade secretary. And it actually can be tapped, as James said earlier. It's not state aid, so it can be tapped in conjunction with CLBILS or in conjunction with CCFF. And it's a term loan which is capped to 5 years door to door, but otherwise it's very flexible. It can be used for general corporate purposes, working capital, capital expenditure. The loan profile can be adjusted to match your cash flows, and while it's expected to be primarily extended in sterling, it's also open to US dollar, euro, and Japanese yen. It has a government guarantee up to 80% through UKEF, but it's documented very simply by a facility agreement under which you have two tranches, one guaranteed fully by the government through UK Export Finance, and the other one which is not covered, not guaranteed, which is a commercial tranche, and a margin component which is paid to UKEF on the fully guaranteed tranche. There is no cap per loan amount, by loan amount, so the maximum loan amount obviously is determined on a case-by-case basis, but as a product, in terms of the product itself, there is no maximum amount. It is rather conceived for large transactions, and the first deal which was signed was back in October last year for 625 million, funding primarily capital expenditure, which is ultimately supporting exports from the UK. The second reason why we think it's an attractive or interesting product is because of its eligibility criteria. You only need to have generated 5% of your sales overseas in each of the past 3 financial years, or if you didn't manage to, or if you didn't generate, or didn't have this, didn't manage to reach this minimum threshold of 5%, to the extent that at least in one of these 3 years, you manage to generate 20% overseas sales, then you would qualify. In terms of the structure, this eligibility criteria is based on a declaration which is translated legally in an undertaking, which is given in a separate agreement entered into between the borrower and UK Export Finance. There can be exceptions to these two eligibility criteria. If there is a compelling export story attached to the loan itself, and the third reason why we think it's an interesting product is because of the key benefits that it's bringing. It's a way to diversify your funding sources and at the same time preserve the bank's capacity, because effectively the bank would only allocate 20 million to 100 million transactions. The other key benefit that we see is that it can attract high quantum for each transaction by leveraging on UKEF's own underwriting capacity. On that note, I will hand over to Scott.
Okay. Thank you, Olivier. Thank you, James, and thank you, Glenn, as well, for those presentations and overviews. Very, very helpful, very insightful. We hope you found it useful. It is very much to try and sort of be by your side in terms of the interpretation, to work with you on the schemes in terms of making sure that we can give you access to liquidity and funding as quickly as possible. The other point I would make is that whilst we, like many others, are working from home at the moment, we've essentially got zero absenteeism across our relationship managers. As James mentioned earlier, they are all very well versed on these schemes. They've been through similar sessions and actually in more detail in terms of the schemes. So we've got a sort of a fully clued up and ready relationship manager population that can assist on this as well. But the other thing I would say is that we focus clearly a lot on the funding schemes at the moment, quite rightly so, given the need for additional liquidity and financing. But there's a lot of good work that we're also doing across our colleague population. This is clearly as much a human challenge as it is a financial challenge. So whether it's work in terms of colleague well-being or mental health, and we're absolutely delighted to share any of our thinking or approach on that as well, given it's been something we've been very focused on during this period as well. But for the sake of this, I hope you found it useful. We're working through any updates that we get. We'll make sure that we're sharing those across our client population. All I would say is stay safe, stay healthy, and we are absolutely here to try and assist you and support you during this difficult time. Thank you very much.